Welcome to the Deep Dive. We cut through the noise on complex topics you ask about, delivering the essential intelligence fast. Today we're tackling Grand Canyon Education GCE. You asked us to dissect their Q2 2025 earnings call from August 6th. And the core question here isn't just about the numbers, it's, well, is GCE actually cracking the code for growth in a really tough higher ed market with their unique strategy? Let's find out. So let's jump straight into the headlines from that call. GCE didn't just meet expectations in Q2, did they? They seemed to blow past them.
Oh, absolutely. It was a significant beat across the board. A very positive picture right away. We saw non-GAAP diluted EPS, that's, earnings per share adjusted for certain items. It came in at $1.53.
Okay.
Which was a solid 16 cents better than the consensus estimate. And service revenue, that also impressed, hit $247.5 million.
Wow.
Yeah, an 8.8% jump year over year. And again, well above what analysts were predicting.
That really is strong performance out of the gate. How did the market take these numbers? What was the reaction?
Unequivocally positive.
Yeah.
Really quite telling, actually. After the call finished, shares saw this huge jump, climbed over 13% by the close the next day.
13%.
Yep, on heavy trading volume too. And it wasn't just a one-day thing. The stock kept climbing, hit record highs later in August. It's a pretty clear signal, Strong investor confidence in how GCE is executing and what they see coming down the line. The market's basically saying, we believe this momentum is real.
Okay, let's unpack that a bit more then. Beyond those headline numbers, what's the deeper story on profitability? How healthy are they operationally?
Well, this is where it gets really interesting, I think. It's not just top-line growth. The profitability expanded significantly. Operating income rose 21.2% year over year. That's $51.8 million. And that pushed the operating margin up to 20.9%. Right. That's a 210 basis point improvement, 2.1 percentage points, which is quite substantial. And adjusted EBITDA, another key measure of operational performance, that saw a healthy 15.2% increase to $67.4 million. It really reflects GCE's kind of asset-light model. They don't have the same huge infrastructure costs as many traditional universities.
Yeah, that makes sense.
So that multi-pillar approach gives them incredible operating leverage. Revenue growth turns into, outsized profit increases. Net income itself grew 19.1% to $41.5 million. So it's not just growth, it's efficient growth.
And you mentioned the tax rate moved favorably, too. What was going on there?
That's right. Yeah, the effective tax rate for Q2 dipped to 24.5%. That's down 100 basis points from last year. Partially, it's down to some strategic tax management, which we can maybe circle back to in a bit.
Okay.
But yeah, these strong metrics across the board, they really highlight a business as not just getting bigger, but doing it profitably and efficiently. It underlines the quality of the earnings.
So given these stellar numbers, the immediate question is, what's driving it? What's the engine behind this enrollment growth across their online, hybrid, and ground campuses? What's the secret sauce?
Exactly the right question. And the CEO on the call really emphasized it was broad-based momentum. Total partner enrollments jumped 10.3% year over year. They hit 117,283 students. Let's break that down a bit.
Yeah, please do.
Okay, so for the online campus that's mainly Grand Canyon University, GCU, their main partner online enrollments grew 10.1%. And new starts, the really key indicator, were up in the mid-teens in Q2. Better than they expected.
Mid-teens, wow.
Yeah. The CEO pointed to a few things. Consistently rolling out over 20 new programs each year. And these are relevant in-demand programs. Then you've got these partnerships with over 5,500 employers that helps address specific workforce shortages. And it's a powerful student funnel.
Right, direct pipeline.
Exactly. Plus, improved retention rates. They're keeping students.
Yeah.
And a disciplined tuition strategy, keeping things accessible. But here's a really crucial factor that seems to be growing. More 18 to 25-year-olds are choosing fully online bachelor's degrees.
Interesting. Not just the older demographic.
Right. And GCU has this huge offering, over 300 online programs, so they're benefiting from that demographic shift. Then you have hybrid enrollment. This is the mix of online and face-to-face. Their off-campus ABSN sites, that's the Accelerated Bachelor of Science in Nursing, saw a 14.0% enrollment increase.
Okay.
And overall hybrid growth, if you exclude sites that were closing or teaching out, was even higher, 15.4%.
Significant.
It is. And it's largely fueled by younger students, maybe with some college credits already, who can efficiently get into these ABSN programs using GCU's online prerequisite courses. Think about this. 17,085 students have already taken these affordable 8-week online courses. It sort of de-risks their path into nursing.
That's smart. Flexible.
Very. And they plan to open 5 more hybrid sites in 2025. That brings GCU's ABSN total up to 11. It's a really modular, scalable approach. And then finally, the ground campus, traditional campus. For fall 2025, new student registrations are actually tracking 10% ahead of last year.
Okay, that's positive.
It is. But total on-campus enrollment is projected to be roughly flat compared to last year. The main reason seems to be more summer graduations. About 300 students accelerated their degrees, finished in summer instead of fall.
Ah, so throughput is up.
Exactly. So while it looks flat on the surface, it actually points to healthy throughput and efficiency in their traditional programs too.
So putting all these pieces together, online, hybrid ground, what does this really mean for GCE strategically? How are they positioned in this, shifting higher ed world?
Well, it means they're positioned, I think, really strategically, almost like a Swiss Army knife for higher education. They can capitalize on these big macro trends we're seeing. Fewer traditional high school grads nationally, a definite shift away from the four-year residential model towards shorter career-focused stuff.
Right. And this undeniable demand for fully online degrees. GCE's model hits all those points. Plus, their Center for Workforce Development with programs for electricians, CNC machinists, aligns perfectly with that demand for skilled trades. Stuff traditional universities often ignore. So they're not just reacting to the market, they're actively shaping their offerings to meet where it's going. Very adaptable.
That adaptability seems key, but how are they dealing with external factors? Specifically, that new higher education bill from the summer. What was management's view on the call?
Yeah, good question. Management sounded significantly confident. They basically said the bill should have little to no impact on their partners, and they felt it largely supports positions GCE has held for a long time.
Really, little to no impact.
That's what they said. And they pointed to a key positive, the creation of the Workforce Pell Grant program. GCE believes this will directly benefit students in their workforce development programs. It gives them a federal funding path into those vocational fields. Okay, that makes sense. But wasn't there concern about changes to loan limits in that bill, especially for graduate programs? Is their confidence maybe a bit optimistic?
That's a fair question, and definitely something for investors to watch. Management did address it. They noted over 90% of their partner programs are undergraduate, where loan limits didn't really change much.
Yeah.
For the graduate programs where limits were adjusted, GCE actually thinks reducing the available funds might decrease overall student debt without blocking access to tuition.
Oh, so?
Their reasoning is that most of their partner grad programs have tuition that's already significantly below those new lower loan limits.
Got it. And
they also said they support the institutional accountability parts of the bill. They don't expect any issues given GCU's relatively low tuition and the high earning potential for graduates in fields like nursing. So while it's a valid point to raise, they seem to have a solid rationale for their confidence level.
Okay, let's shift to how they're managing the money. Capital allocation. They've been buying back quite a bit of stock, haven't they? What's the strategy there? What does it tell us?
Yeah, they've been pretty aggressive. It really signals that management believes their stock is undervalued. In Q2, they bought back about 259,000 shares for roughly $47.4 million. And they bought another 157,000 shares after June 30th. Now, this does mean lower interest income because their cash balance goes down.
Right.
But the main goal is reducing the number of shares out there, which boosts EPS. The board keeps authorizing these buybacks because they're looking at metrics like enterprise value to EBITDA, free cash flow yield. Basically, they think the company generates more value in cash than the current stock price reflects. It's a direct way to return value to shareholders.
And sticking with financials, what about that tax strategy I mentioned earlier? How are they managing the rate?
All right, they're being quite strategic about it, and it affects the guidance. That lower Q2 rate, 24.5%, was partly due to state tax changes. But here's the really clever bit. In July, GCE made $5 million in contributions instead of paying state income taxes.
How does that work?
These contributions act as dollar-for-dollar tax credits. So it directly cuts their Arizona state tax bill, and the money supports private school scholarships.
Ah, interesting. Win-win.
Pretty much. And that move alone helped lower their full-year tax rate guidance down to 22.3%. It's a smart play, good for the bottom line, and, good PR locally, too.
Okay, but are there other operational costs we should be watching? Things that might put pressure on margins, especially looking ahead?
Yeah, a few things to keep an eye on. GCE said they expect to keep investing in headcount and tech services, especially in the second half. That's needed to support the growth goals.
Spending to grow. Makes sense.
Right. Also, benefit costs are expected to stay significantly higher than they first thought. That's a headwind a lot of companies are facing. And finally, legal fees. They project those will increase compared to 2024 because several older lawsuits are moving into discovery or trial phases in 2025.
Okay.
So those are all factors that could, temper profitability if they're not managed really carefully. Worth watching.
So we've covered the past quarter, the current dynamics. Let's look forward. Management updated their guidance. What are they telling us to expect for the rest of 2025? How confident do they sound?
They definitely sound confident. They actually raised and tightened their guidance range, which reflects that strong Q2 beat. For Q3, they're projecting service revenue between $258.5 and $260.5 million. Non-GAAP EPS between $1.75 and $1.80.
Okay.
Operating margin expected between 21.8% and 22.2%. Then looking at the Q4, service revenue projected $305 to $310 million. Non-GAAP EPS, $3.13 to $3.24. And a really strong operating margin forecast, 35.1% to 35.8%.
Q4 looks strong.
Yeah. So for the full year 2025, they're now projecting service revenue around $1.1 billion, $1,100.3 to $1,107.3 million. Full year non-GAAP EPS is guided to $8.98 to $9.14, and operating margin between 27.5% and 27.9%.
And enrollment expectation underpinning that.
They expect new online enrollment growth in the mid to high single digits for the second half, and hybrid growth mid to high teens. So yeah, this robust outlook combined with the Q2 beat, that's really what's fueling that positive market reaction we talked about. It tells you management sees this momentum continuing.
Okay, this really does paint a picture of a company hitting its stride, executing well, but let's zoom out. How does GCE's performance fit into the bigger picture of the education services sector? What data points from this call really cement their position as maybe a leader here?
Well, they're definitely pushing that execution-led acceleration narrative hard, and the data seems to back it up. The strong Q2, the raised guidance that confirms the broad enrollment strength, and those solid margins. But what really sets them apart, I think, are those expanding operating margins we discussed, that 2 and 10 basis point jump.
Great.
That's tangible proof of their asset-light model working, their efficiency, and the strategic growth in hybrid ABSN, plus capturing those younger 18 to 25-year-olds online. That shows they're successfully diversifying and finding new markets.
So it's not just luck.
Doesn't seem like it. It looks like a clear alignment between their strategy focusing on flexible, workforce-ready programs, employer links, and the actual financial results. They're not just riding the wave. They seem to be actively shaping their part of the market.
So for you listening and maybe an investor, maybe just watching the industry, what are the key catalysts to watch that could push GCE even higher? And what are the risks to keep on the radar?
Go with catalysts. Definitely keep an eye on Q3 intake trends. Does that new start strength continue, especially online and hybrid? That's critical. Also, watch the productivity from those new hybrid sites. Do they ramp up and deliver enrollments as expected? And any more news or clarity on how that workforce Pell Grant program actually plays out could be a tailwind, since it feeds right into their vocational strategy. On the risk side, managing those partner contract dynamics, sometimes that can put a little pressure on revenue per student. Need to watch that.
Okay.
And as we mentioned, those rising benefit and legal costs, they're headwinds. Need to see if they stay within projections or start to bite more into profits. But overall, despite those risks, the picture really suggests GCE is in a strong position in this changing education landscape.
All right. You've heard the numbers, the strategy, the outlook. Now for our final provocative thought, something for you to maybe mull over, building on all this.
Okay, so given GCE's demonstrated ability to grab market share in high demand areas like nursing, skilled trades, and with workforce Pell potentially boosting those areas further. Consider this potential dynamic, maybe a long position in GCE, ticker LOPE, paired with a short position in, say, a regional, very tuition-dependent private university, or maybe even a traditional state university ETF.
Interesting. What's the thinking?
The core idea is that GCE's agile, career-focused, diverse model lets it thrive as traditional high school grad numbers fall, and the shift to vocational and online accelerates. Meanwhile, many smaller, less adaptable institutions, they could face real enrollment pressure, fiscal challenges. We saw hints of that competitive dynamic in the call.
Right.
So this theoretical trade tries to exploit that potential divergence, the gap widening between innovative market-savvy providers like GCE and those perhaps struggling to keep up.
Okay, a fascinating idea to consider. But remember, everyone, this information is strictly for educational purposes. It is absolutely not financial advice. Always, always do your own research before making any investment decisions. We really hope this deep dive into GCE's earnings call gave you some valuable insights into a company that definitely seems to be carving out a unique path in higher education. Thanks for tuning in to The Deep Dive.